This is Big Picture Earnings Analysis. Today, we're looking at AppLovin Corporation, ticker APP. We've got their Q4 and full year 2025 results. It's a beat, a raise, and a massive stock drop. Let's get into it.
It's a fascinating setup. You
Yeah.
rarely see a divergence this wide between fundamentals and sentiment.
So let's start with the headline numbers because, frankly, they're eye-watering.
They really are.
We aren't talking about a small startup anymore. This is a huge player. For the fourth quarter of 2025, AppLovin reported revenue of $1.66 billion.
And to frame that for everyone, the street consensus, what analysts were modeling, was sitting around $1.61 billion.
So a healthy beat.
A very healthy beat. But the raw number matters less than the trajectory. That $1.66 billion, that's a 66% increase year over year.
66%. I just want to pause on that for a second.
Yeah.
Because I feel like we get desensitized to these numbers. Growing 66% when you're already doing $1 billion a quarter is just a completely different animal.
It puts them in very rarefied air. Usually, as the company scales, growth naturally compresses. AppLovin is somehow accelerating.
And it didn't just stay at the top line, right? The flow through to earnings was even stronger. They reported diluted earnings per share of $3.24.
Against a consensus of $2.96.
Yeah.
So that is a massive beat.
A huge
We're talking about a nearly 10% beat on the bottom line. It shows they aren't just, buying this revenue with crazy spending. They're running a very tight ship.
And the full year numbers, just to cap this off, $5.48 billion in revenue for 2025, up 70%.
70.
But, as we always say, the market is a forward-looking machine. So what do they say about Q1 of 2026?
This is where the story gets really interesting. Because typically, you'd expect management to play it safe here. Sandbag the guidance a bit.
Set a low bar to beat.
Exactly. AppLovin didn't do that. For Q1 2026, they are guiding for revenue between $1.745 billion and $1.775 billion.
Which is, again, above the street estimates of around $1.7 billion.
Correct. So they're guiding for sequential growth on top of their monster Q4.
So by every traditional metric past performance, future guidance, this was a perfect report, an absolute crusher.
It was.
Okay, so let's look at the scoreboard. Massive revenue beat. Massive earnings beat. Strong forward guidance. You'd assume shares were up, 10, maybe 15% after hours?
You would certainly think so.
But they are not. As we're talking, AppLovin stock is down over 7%.
And that's after it was already down about 17% in the weeks leading up to this.
So the market is effectively saying, we don't care about your numbers. Why? What is the invisible monster in the room?
The monster has a name.
Okay.
Google Genie 3.
All right. We have to break this down. We hear Genie 3 and AI disruption thrown around all the time. What does this actually mean for AppLovin specifically? Why does a Google update make investors dump a stock that's growing at 66%?
To understand the threat, you have to understand AppLovin's engine. It's an AI called AXON. And you can think of AXON like a high-frequency trading algorithm, but instead of stocks, it's trading attention.
So it's a prediction machine. It matches the highest value user with the advertiser who's willing to pay the most for them.
Exactly. And that machine runs on fuel, and that fuel is data, signals.
Right.
This is where Google Genie 3 comes in. The fear is that Google's new update is going to change the architecture of Android and the Play Store to basically hide those signals.
So it's the black box scenario. Google puts a wall around the user data for privacy reasons, and suddenly Exxon goes blind.
That is the bear case, 100%. If Genie 3 restricts that identifier data, kind of like what Apple did with IDFA a few years ago, then AppLovin's ability to predict outcomes just plummets.
And if prediction accuracy drops, advertisers won't pay as much.
And then revenue craters.
Yes.
The market is selling the stock because they believe the algorithm is about to break.
So investors are looking at 66% growth and saying, this is the peak. This is as good as it gets before Google turns off the lights.
Precisely. They view these earnings as a lagging indicator, a snapshot of the past. The stock price is a prediction about the future.
But here's what I don't get. If the threat is that imminent, wouldn't we see some cracks already?
You think so?
Before a system breaks, it gets inefficient, costs go up, margins compress.
And that is the most confusing part of this puzzle.
Yeah.
Because if you look at the efficiency metrics in this report, there is zero evidence of disruption. In fact, it's the complete opposite. The margins they just reported are, they're hard to believe.
Let's get into that because I looked at the Adjusted EBITDA margin and I honestly thought it was a typo.
We all did.
They reported an Adjusted EBITDA margin of 84% for Q4.
80? It's not a typo.
Hold on, stop there. 84%. Do you realize how insane that is? I mean, the best sauce companies high-five each other if they hit 40 or 50%. Visa and MasterCard, which are basically toll booths on the global economy, run in the 60s or 70s.
Right.
How is an ad tech company printing 84% EBITDA margins?
It comes down to operating leverage. Pure, unadulterated operating leverage.
Meaning their costs are fixed while revenue just explodes.
That's it. Think about it. AppLovin doesn't need to hire 1,000 new salespeople to sell $1 billion more in ads. The Acon engine does the selling. It's automated.
So every incremental dollar that comes in basically drops straight to the bottom line.
Almost all of it. Their net income grew 84%, which actually outpaced their revenue growth. That's the definition of leverage. If they were struggling with Google changes, those margins would be shrinking, not expanding.
It almost feels like they're defying the laws of business gravity. An 84% margin implies they are spending almost nothing to generate that revenue.
It implies their tech is just that much better than the competition's.
A monopoly on performance.
Essentially. When your algorithm works twice as well as the next guy's, you can command pricing power that leads to, well, to margins like these.
Okay, so the P&L is beautiful, but, as an investor, I've been burned by accounting profits before. EBITDA can be massaged.
Sure.
Let's talk cold, hard cash.
This is where the bull case gets its second wind. We have to look at free cash flow. For Q4 alone, they generated $1.31 billion in free cash flow.
And for the full year,
$3.95 billion.
nearly $4 billion in cash.
And here's the tell, right? Their net cash from operating activities was almost identical to their free cash flow.
Which means what? Almost no CapEx.
Essentially zero. They aren't building factories. They aren't laying fiber. It is an incredibly asset-light model. They generated $4 billion in cash and had to reinvest almost none of it.
So they're just sitting on a mountain of cash. In this environment, you'd expect them to hoard it. Build a war chest for the Genie 3 apocalypse.
That would be the conservative play. But that's not what they're doing. No. And this is the strongest signal management can possibly send. They are aggressively buying back their own stock.
How aggressively?
For the full year, they repurchased 6.4 million shares at a cost of $2.58 billion.
Wait. So out of the nearly $4 billion in cash they generated, they spent over $2.5 billion buying their own shares.
That's right. They returned the majority of their free cash flow to shareholders via buybacks.
That is a massive bet on themselves.
It is. I mean, think about the psychology. The market is screaming, Google is going to kill your business.
Right.
And AppLovin's management is looking at their bank account and saying, we disagree. We think our stock is cheap. We're going to buy as much of it as we can.
It's definitely not the behavior of a management team that's scared of the future.
Not at all.
No.
And just to double check the safety here, we should look at the balance sheet. They aren't borrowing money to do this.
Good point.
In fact, their cash position actually improved. They ended the year with $2.49 billion in cash, up from just under $700 million the year before.
So they bought back massive amounts of stock and still tripled their cash on hand.
Correct. They have roughly $3.5 billion in long-term debt. With $2.5 billion in cash, they could pay off a huge chunk of it if they wanted to.
But they're choosing buybacks instead.
They believe the return on their own equity is higher than the interest cost. It's a very offensive capital allocation strategy.
Okay, let's circle back to the future, to that Q1 2026 guidance.
Yeah.
We talked about the revenue, but what about the margin forecast? Surely they're forecasting lower margins to account for all this turbulence.
You would think so. If you expect your targeting to get worse, your margins should compress. But let's look at the guidance. Revenue, $1.745 to $1.775 billion. Adjusted EBITDA, 1.465 to 1.495 billion.
I'm doing the napkin math here. That's still 84%.
It is exactly 84%. They are guiding for peak efficiency to continue into the next quarter.
That is the ultimate rebuttal to the bear case, isn't it?
It is hard to argue with. The market is pricing in a disaster. Management is guiding for business as usual. And business as usual for them happens to be, maybe the most profitable model in ad tech history.
It implies that management either doesn't see Genie 3 as a threat, or they believe Axon is smart enough to work around it.
Or, and this is a really interesting thought, maybe Axon has become so advanced it doesn't need the same granular identity data anymore.
You mean it can predict user behavior based on other signals, contextual signals?
Exactly. And if that's the case, Google's privacy updates might not hurt them at all. They might even help them if their competitors can't adapt as fast.
That's a fascinating angle. If the black docs blinds everyone, the company with the best AI wins by default.
It's the survival of the fittest theory. In a data-poor world, the algorithm is king.
So we're left with a pretty stark choice for the listener here.
It's a real binary outcome. On one side, the bull case. You have a company growing at 66% with 84% margins, and management is buying back stock hand over fist.
And on the other side, the bear case. The ecosystem is changing. Google holds all the cards. And the market believes these incredible margins are a peak that's about to crash back to earth.
It's the classic battle between hard financial data and narrative fear. The data says buy, the narrative says run.
So as we wrap up, what's the final thought for the investor who's staring at that red stock ticker today?
I think you have to ask yourself, is the market pricing in a ghost? Is it possible that the disruption everyone fears has already been solved by their technology? If AppLovin can maintain 80+% margins in a post-privacy world, the sell-off isn't just a correction, it's a massive mispricing of risk.
But if Google really does pull the rug out,
Then that 84% margin has a long, long way to fall.
the market hates uncertainty, and right now, AppLovin is the definition of uncertainty wrapped in a gold-plated income statement. Thanks for tuning in to Big Picture Earnings Analysis. We'll see you next time.